Hi everyone, welcome to the where ESG ambition meet actions. A look at impact investing. My name is Bruno Bensaid. I will be the moderator for this webinar organized by our team today. I'd like to first introduce the seminar and the questions that we're going to cover today. First of all, why is the market for impact investing becoming such a high agenda item for PE firms? What are the main challenges and opportunities when setting up an impact-focused fund? How do PE firms integrate impact data and ESG in their due diligence process? And what are the best ways for PE firms to demonstrate impactful outcomes and measure returns? So without further ado, I'd like to first introduce our panelists and speakers. Obviously, Apex, the organizer today, Sara Laabid, who leads product development and delivery for impact investors in private markets at Apex. Matthew Powell, head of ESG and reporting at Beyond Net Zero. And Luca De Breed, director investment at Bright Edge, the American Cancer Society mission-driven venture capital fund. So if you're okay, Matthew and Lucas, why don't you introduce yourselves? And I would like in third for Sara to introduce herself and then move to her presentation, the Apex presentation on ESG. So Matthew, why don't you get started?
Thank you, Bruno. It's very good to be here. Hello, everyone. My name is Matthew Powell, and I head up ESG and reporting at Beyond Net Zero. Beyond Net Zero is a $3.5 billion climate fund. We're part of the global growth equity firm General Atlantic, and we have a specific mandate to invest in companies which are delivering climate solutions. We're an Article 9 fund under SFDR, and we have some, I think, relatively strict requirements around climate targets related to science-based targets, which we require everyone to set, and also measuring and tracking avoided emissions. Prior to this role, I spent several years as Chief of Staff to John Brown, the former CEO of BP.
Sounds good. Thank you, Matthew. Lucas?
Yes, hi everyone. Thank you again for including me. I'm Lucas De Breed, Director of Investments at Bright Edge, and we are indeed the impact investment and venture capital arm of the American Cancer Society. So what that means is that we're focused on investing for double bottom line return, so both financial market rate financial return as well as impact from the vantage point of cancer patients, which has been the key constituency of the American Society for over 100 years since it was founded. And so we're intentionally looking for investment opportunities that are laser focused on serving cancer patient needs and take a modality agnostic approach to that. So we do invest in some of the classical venture categories of therapeutics, medical device diagnostics, but also very interested in digital solutions that can help support patient needs, as well as even be involved in prevention of cancer even emerging in the first place.
Wonderful. Thank you, Lucas. Thank you very much. Sara, please introduce yourself, Apex, and happy to discover your presentation.
Great. Thank you, Bruno. And hello, everybody. I'm the impact lead here at Apex, where I lead the development and delivery of solutions for impact investors in the private market. I'm one of many in the ESG and impact team, and along our CEO, we're using the might of Apex to drive meaningful and measurable change. To set the scene, I'd like to share some insights about our experience in the impact investing market at Apex. The Apex Group is a global financial services provider present in over 80 locations around the world and servicing 3 trillion worth of assets. In the ESG and impact team, we support over 400 GPs and LPs in the private market and over 2,000 portfolio companies to answer 3 key questions: what data to collect, how to collect that data, and what to do with it to drive meaningful, measurable change. A question that I get asked all the time by specialists and people outside of the financial field is, what is actually impact investing? And although it can mean different things to different people, there is a useful definition from the Global Impact Investing Network, or GIN, that helps provide some clarity and framework around such. According to the GIN, there are 4 key tenets that are underlying impact investing. The first one is intentionality, or seeking to generate environmental and social impact. This really is a key differentiator between impact investing and ESG, where ESG tends to focus on the effect of sustainability factors on financial returns. Secondly, measurement is a hallmark of impact investing, where there's a commitment to measure and transparently report impact performance. Thirdly, financial returns, according to the GIN, can range from below market rate to risk-adjusted market rate, and impact investing can be made across all asset classes. As per 2022, there were roughly 1 trillion of AUM invested in impact, predominantly in Europe and North America. Now, the key question is, what is really driving impact investing? And there are 4 key factors that we're noticing from our client base. The first one is an increase in market demand, including from asset allocators. Secondly, there's a substantial public funding gap. McKinsey estimates that $9 trillion USD per year are required for the net zero transition, and they won't solely come from the public purse. Thirdly, and perhaps importantly, impact investing allows investors to stand out in an increasingly competitive market, and our clients are increasingly wishing to direct funds towards valuable investments in the mid to long term, and through impact investing, they're able to increase the pool of buyers in 3 to 5 years, therefore increasing the value of their assets. However, what are challenges facing impact investors? We've bucketed these into 3 main themes that we see across our clients, both GPs and LPs. Firstly, scrutiny and skepticism, which comes with increased awareness and ambition. There is more caution in accepting rhetoric-heavy reports and wanting to see data behind that. Secondly, while most impact investors are collecting information, the integrity and the worth of their data is key. Self-reported and verified data often comes from SaaS platform, increases the risk of garbage in and garbage out, and accusations of marking your own homework. At Apex, we operate a triple check policy where each data point is independently verified by 3 analysts to ensure the integrity of the data. Lastly, scale and sophistication is a crucial angle in impact investing. There is a huge growth in this space and definitely a fear of missing out. So there really is a danger here of rushing ahead without fully thinking through how to address scrutiny and skepticism. At Apex, we have a wide range of impact-focused solutions that help impact investors gather data and drive change. This includes the Impact Positive solution, which supports investors with pre-investment checks, impact monitoring, verifying their data, and reporting on it. The EU taxonomy solution also helps to demonstrate regulatory alignment, and there are a range of sort of deep dive in specific areas of impact, such as diversity, equity, equality, and inclusion, and climate carbon solutions, which both sort of go beyond data gathering and calculations to outlining practical steps to drive positive impact going forward. This is the state of the market from an Apex perspective. And to wrap up, I think it's first to say that most forward-thinking progressive investors are thinking seriously about impact investing, And this is really a core area for the 400 GPs and LPs which we're working with. We're always happy to hear from impact investors around the world. So if you want to get in touch, feel free to reach out on the email address on the upper right-hand side corner.
Wonderful, wonderful. Well, talking about EU taxonomy, I guess this is where we're going to move to the first poll question. For those who don't know, I mean, you have an option in the poll question to say to mention that you're not aware. Otherwise, we'd like to understand from you guys what is exactly, if you believe that the EU taxonomy is something that is clear, or does it need further requirements? So let's move to the poll question. I'd like to hear a little bit more from Matthew, Lucas now on how do you deal with different and potentially conflicting understandings of impact investing and ESG, especially in regards to how you deal with your investors, your LPs, and your portfolio companies. So, Matthew, why don't you start if you'd like?
Sure. Yeah, happy to. Thanks, Bruno. I want to make two points on this. So, firstly, and I think Sara perhaps alluded to this in her presentation, I think it's really, really important that when you talk about an impact fund or impact investing, that at the same time you talk about what that means to your financial returns. There is a spectrum. There's a spectrum of we'll accept lower returns in exchange for impact, and then there's the opposite, and that's where, rather not the opposite, but we want to achieve financial returns commensurate with what you'd expect from a growth equity firm, and we also think we can deliver impact at the same time. And if I reflect on the past 18 months of fundraising for Beyond Net Zero, we spent a lot of time just establishing that ground rule, because impact means very different things to different people in that respect. And second point as well, and I still think that even today there is a general confusion about the difference between ESG and impact. We're an Article 9 fund. We will collect data on a number of KPIs. Those are not our impact KPIs. they are.
Matthew, can I stop you for a second? Maybe for our audience, can you just share very quickly what is Article 9, if you may?
Of course. So in the European Union, there's something called SFDR, which is the Sustainable Finance Disclosure Regulation. And for EU domiciled funds, you now have to decide whether you are in one of three categories. The highest of those categories is Article 9, and that means you commit to a very high standard of ESG disclosure. It's really a disclosure regime, but it's become more of a classification system, and people think if you're Article 9, then you're great, and if you're not, then you're not so good. I'm not sure that's entirely correct, but that's how people generally have started to see it. But it's an ESG regime. It's about what ESG KPIs are you going to disclose? Are you going to track over time? And we did spend a lot of time explaining to investors and also to our portfolio companies that we're collecting this data. These are not our impact metrics. We don't exist as a fund in order to target improvements in certain ones of these metrics. Our impact mandate is very focused on greenhouse gas emissions and climate. So I think separating those two things, for a lot of people on this call, maybe that it might seem quite basic, but actually I think largely still needs a lot of work to explain that difference.
And the other two classifications would be Article 8 and
Article
EU
6.
taxonomy?
No, Article 6, 8, and 9. Don't ask me what happened to 7. I'm not sure anybody knows. But
no worries, no worries.
9. And then the EU taxonomy, which is on this polling screen now, is a very separate thing.
Understood. So you have an impact mandate on specific products. You have an investment thesis. In addition to that, or in the same time, you're compliant with Article 9 of the classification for ESG. So you have some kind of two different things that you need to explain to your LPs. How difficult or easy is that to convey all these concepts to them?
Look, I think you can't give a generalized answer to that because it depends on who you're talking to and the level of knowledge people already have. But I think the point I just want to make is it does require explanation, because the two are very, very, very quickly and easily get confused, and then you start going down completely the wrong track.
What about you, Lucas? Is that something that you've faced? Explanation or lengthy explanation work that is necessary? How do you deal with it?
Yeah, I think we are a pretty unique case in that sense that we, even if you talk about ESG, right, we completely embrace that as an opportunity just for call it good corporate functioning, and as such have more consideration and measurement around that. But one of the things we often advocate is that health is not really a substantial part of it, and it probably should be. And then as a true impact investor, we are much more focused on being intentional around achieving positive results, right? And so given that we are exclusively focused on cancer, we actually have utilized the IMP5 framework, so Impact Management Principles 5-dimension framework, to develop a dedicated cancer impact investment framework. And we utilize that both for assessing investment opportunities as well as then using that for impact reporting. So we've embraced that. ESG is a great, I would say, universal tool that we're certainly also factoring into our functioning. We don't have sort of reporting obligations tied to ESG as such, but because we're very intentional already about what we're trying to accomplish, we actually welcome the opportunity to build on ESG frameworks and layer that in alongside our dedicated impact framework.
Understood. Thanks, Lucas. So, Sara, ESG is what you live and breathe every day. How does that? Are you able to convey these different concepts to your clients? How easy or difficult is it?
I think we've definitely seen the ESG space becoming that sort of complex alphabet soup, and a lot of investors definitely need clarity and need that sort of heavy lifting taken off them. I think the core added value that we try to add is really distilling all that text and conveying it in a very simple fashion, and sometimes also trying to sort of make processes really efficient around a regulatory requirement and so on.
Got it. I think we have the results of the poll, and I guess it's more on the either it needs refinement or there needs a bit further explanation. And I kind of agree. Listening to your comments, Sara, Matthew, especially, that there needs to be an ongoing effort of explanation, education of the market on the taxonomy, how it evolves, how complex it is, and make it simple for them. So that being said, the fact that it's becoming more complicated every day, and that the regulation is getting more stricter, more sophisticated, do you think it's going to be an obstacle for the impact investing industry, especially in regards to disclosure, labeling requirements, and so on? So, Matthew, do you want to take this on?
So I think that an increase in and a standardization of requirements is generally going to be a good thing, because I think we didn't have this so much, but I think a lot of our peers and people I've talked to really suffer from everybody asking for something slightly different, and you end up catering to bespoke investor requests. One of the advantages we had is that we launched in 2021 with a blank sheet of paper, decided to be an Article 9 fund. That's our regulatory disclosure regime. We have, we do some separate impact reporting, but our regulatory ESG disclosure regime is Article 9. And whenever somebody came to us and said, we'd like to invest and we'd like you to report on this, and we said, well, actually, no, we're doing it this way because this is what the regulation requires. And it gave us some of the ammunition you need to push back a little bit on those requests, which can sometimes become unmanageable.
And so you've put together the resources to manage that complexity. I guess there's an impact also on your own P&L. So you need to have all the different resources ready to answer the more complex regulation, right? Tell us about this if you can.
Absolutely, and I just see anecdotally that there's a big difference between the large funds that perhaps have the resources to put behind this and much smaller funds that don't, and that is inevitably going to lead in the first few years of this new regulation. I know this webinar is not meant to be about Article 9 SFDR, but that's just my experience. That's inevitably going to lead in the first few years to a big sort of bifurcation of the quality of disclosures that are made. I think some funds are putting a lot of resources behind it, and they're going to come out with a lot of detail. Other funds that on paper are meant to be following the same regime are not going to. And I think that in itself is going to drive further regulatory change, because you can't have a great level of inconsistency for long. So I expect the EU to will continue to react and evolve.
Can I have a follow-on question to that? So that means you probably need to have a certain size in order to be comfortable just implementing, or a small fund, but because you're a bigger one, but a smaller fund might have more difficulty to just put together these resources.
I mean, that's the implication, but I think that's a bad outcome. These regimes shouldn't matter. I don't think you shouldn't be choosing your level of ESG disclosure on the basis of the resources that you have. I think that's not quite what everyone would like. So I think that the streamlining of these requirements, I think that will happen over time.
Okay, Lucas, increased regulation is good.
I mean, I think increased guidance on how to implement regulation will be good. And I think also we'll see what happens, right? Clearly, EU has been a bit of a leader in that. I mean, there's different discussions about what this may do for US regulation. I think the jury's still out on that one. But I do think driving towards clarity on actually how to implement it will be very helpful. And I think, again, groups like us who actually are keen to embrace it proactively, because it's very much aligned with our philosophy of being intentional and sustainable investor, when it's made straightforward and easy to implement, I think a lot of groups will actually embrace it, and then hopefully there will be this learning cycle where some of the kinks in the cable will eventually be removed, because clearly there are just operational challenges around them, and so I think kind of having that cycle between regulation and practitioner feedback will actually be very welcomed.
And who would give you more guidance then? I mean, would that be companies like Apex or work groups? Where's the guidance coming from, or would it be?
Yeah, I mean, clearly, we've been working with Apex on that, also understanding, indeed, on an operational standpoint, how do you actually implement that, and what's more low-hanging versus other items that might be more bespoke, right? And I mean, I also think we shouldn't fool ourselves that it's going to be very difficult to have a universal framework that can be applied across. I mean, even within our space, when we look at different solutions that can help cancer patients, we cannot drive towards a universal metric around the impact that we want to achieve, just because that's really becomes a matter of force fitting. So clearly, and that's just in one particular case. If you cut across different industries and even geographies, it becomes very hard to have a uniform, call it assessment tool. And that's why I think there will always be a need for dedicated groups that can help support investors in at least advancing the interpretation and the standardization on how you actually fulfill requirements. Yeah.
Yes, exactly. Because Sara, you were talking about alphabet soup, and you're what you do on a daily basis is to distill that, and also to advise these funds and to advise on how to make everything more transparent and to assess better. But intuitively, as an outsider, although I've been working on ESG and teaching about ESG in some of my classes, because I do a bit of teaching, wouldn't that be more simple if there was some kind of unification? Sara, what do you think? How to unify all this? Or is that is that something that is just not reachable?
I think it's very hard to reach, I think there are many trade-offs when you are a regulator and writing this sort of text. You want to make it generalizable enough so that many companies can apply that, but the danger in that is that it does create some complexity. And I think what Lucas just said, and Matthew as well, is really, some of the key echoes we get from the industry day in and day out is, this is really demanding, and how can I practically apply the legal text to my particular portfolio? So, a core part to what we do as part of the EU taxonomies, as I said, distilling the legal text, translating it into layman terms for particular companies, and making the assessment process as efficient as possible. And I think more importantly, outlining a practical roadmap to maximizing the alignment scores.
So moving, a good segue to exactly what do you advise your clients to collect, monitor, and evaluate as far as the data is concerned? How do you advise them, or on what to collect and what to do, Sara?
I mean, on impact generally, I think there are various options there, and most of our clients prefer to start simple and then build up in terms of complexity. But the desired degree of complexity is also mainly driven by investors' demand. As a baseline, I would say that as part of due diligence, one would collect data on ESG and a materiality assessment to understand the areas of impact that are important for portfolio companies. And during the investment, what's really key is sort of choosing material impact KPIs and comparing them to a benchmark. I think what makes the impact world, quite complex is that there's no one size fits all, and impact is very multidimensional, and there are various options out there. I think for people who are willing to go more advanced, typically what we see as part of the due diligence process is sort of assessing impact potential, setting impact targets. And during the investment itself, very similar to what Lucas was saying earlier, collecting data across the 5 dimensions of impact as identified by the impact management project.
Okay. Matthew, what do you collect as far as impact data? Or is it different for all the companies that you're working with? There has to be some kind of a framework.
Yeah, we try to make it as consistent as possible across all of our portfolio companies, and I think it's really, from an impact perspective, 2 things. One is that we require all our companies to report their greenhouse gas footprint, and that in alone is not impact, but the impact part is we require them to set a science-based target to reduce their emissions over time. So, that we think of that as something that we've required, so it's in a certain extent, it's our impact as an investor, and we track how they're doing against that. The other half of this is we also spend a lot of time pre-investment developing a climate model for each company that we look at, and we use that to try to make an estimate of the avoided emissions that a company's products or service will generate or enable. And we work with the company post-investment to track that over time, and see how the company's doing against our target. So, in theory, at the end of the investment, whether it's 3, 4, 5, 6 years, we'll be able to say, while we own this investment, the company generated X megatons of avoided emissions, and our share of that is Y. And that's one a really key impact metric for us.
2 quick questions. You talked about measuring their footprint, or like CO2 footprint, something.
Yeah.
What tools do you give them, tools or methodology to do that, or they know already?
So we give them guidance, and we provide what you might call a bit of a toolkit. We don't do it for them. We don't tell them exactly who to use or how to do it. I think some investors might. I think we decided to let people figure it out for themselves, as long as they're following the industry standard greenhouse gas protocol for measuring them.
Got it. And second question, you're an impact investor. I would assume that the companies you invest in already quite versed into these tools. So by definition, your work should be made easier because they could even teach you how to measure green gas emission by definition. I mean, because they are the startups that you invest in.
Yeah, it's a complete mix, Bruno, to be honest. So we've had some investments, I would say, probably more those based in Europe, who are more familiar with these tools, and maybe they've already done a little bit of what we're asking, but not all of it. We have other investments in other parts of the world where they're clearly delivering a climate solution, and there is clearly avoided emissions associated with that, but they've never really thought about it that way. They've certainly never measured their own greenhouse gas footprint, and they've certainly never thought about setting a target to reduce that footprint over time. So I think it's actually not, whilst we always find we're pushing on an open door, we find a lot of companies who are definitely climate solutions, but have never really thought about it in the way we do.
Got it. Thank you. Lucas, you're more US-centric.
Yeah, but some of the themes...
Yeah.
Yeah, some of the themes do relate to what Matthew was just saying, because again, even though ESG is not as well implemented either on the kind of called the push or the pull side, right? There is growing awareness, particularly at the public company level. I mean, us as venture investors are primarily focused on private companies, and in that realm, there is typically the kind of the position that, well, we're already active in healthcare, right? So we must be impact positive, right? We're trying to solve some of humanity's biggest challenges, but that's not necessarily always valid, particularly when you look at it on a relative basis, right? When you try to understand how much is, say, this new drug actually going to make a difference for patients versus how is it going to feed into perhaps the established needs of pharma companies that are facing patent cliffs and are trying to fill up their pipelines with enough activity, and will reward handsomely for a drug that's been taken through some early stages of clinical testing. And so that's where, there can be a separation between what can make sense from a financial return perspective versus what will actually generate impact. And so we welcome the opportunity, again, particularly in our domain of oncology, to really be a leader in trying to set those standards so that actually there's a tool available to navigate impact, and it's not just assumed or kind of taken as a given, because we do believe actually there is a need to drill down on that a little bit further and be more selective in what actually is going to have those pre-specified outcomes, particularly on the sort of social health level, but that's on the specifically to patients that are struggling with cancer. But we believe cancer is also a systemic issue, right? It's certainly touching many aspects of society, whether it's for workforce productivity, either for patients or their caregivers, and just the general health of the of society at large. It has certainly many ripple effects. So we believe there's a room for us to fill that void and help also bring in the impact consideration into a landscape which currently is not as enabled to actually assess that.
Okay. Sara, a quick word. Thanks, Lucas. Sara, a quick word on data collection and what you advise your clients on what to collect, monitor.
Nothing much more than what I said earlier. I think the key point is really to do it with integrity.
Okay.
And, I think there is a danger.
Sorry, we'll move on to data integrity in the next question. So no worries. So I'd like to send to publish a new poll for our audience, and specifically, how much do you believe investors and corporations are still greenwashing instead of truly implementing ESG, DNI, CSR, etc. So we'll publish the poll, and indeed we'll move on to data integrity. So since Sara, you started talking about data integrity and greenwashing, so can you share a bit of your experience on what you've seen in the market regarding some of your clients or bad apples that you've seen in the market? And that could be your clients as well. It's just that they need to perhaps change a little bit what they're doing.
Interestingly, I think most of the portfolio companies we've been working with are not under, they're not over declaring, but they're under declaring.
Why is that?
And I think that there is currently an understanding of the risk of greenwashing, and people tend to err on the side of caution. And so, as I said, with a lot of portfolio companies we're seeing, maybe they don't have a full understanding of what they're doing, or they don't think that, you know, having things mentioned in their policy means that they're aligned with framework X. So the sort of inaccuracy we've seen while doing the data verification showed that portfolio companies tended to under declare. I think the other key theme I've noticed is that it's becoming less and less acceptable for companies and investors to sort of mark their own homework. And as I said earlier, this really sort of lead to that practice of garbage in and garbage out. So a core part of our services is really that sort of checking that every data point has, you know, there's evidence behind it to back it up.
Got it. Matthew, what are the tools that you're using to detect some kind of a greenwashing activity going on at prospective targets or existing portfolio companies?
Yeah, so I was really struck Sara used the phrase about not marking your own homework, and that was a phrase which I think was in, you know, version 1 of our own pitch book when we started developing the fund, and we wanted to make sure that we also were never, you know, seen to be doing that or in reality doing that. So one of the earliest strategic decisions we took was to form a partnership with a third party, an independent third party who, frankly, I think they're in, you know, the way we talk about it is that their integrity as a firm was more important to them than their contract with us, and that's really important. So they monitor, they're deeply embedded in our investment process, and do sort of support us on the climate diligence of targets. And then when we work with portfolio companies, actually work with them to ensure that what we think is going on is actually going on from a climate impact perspective. And then when we report to our investors, you know, any numbers you see coming out of our fund, you can be confident that they've gone through that third party. I don't call it an audit because it's not an audit process, but it's a sort of integrity assurance process. I didn't want to just call, you know, you're talking about data integrity and greenwashing in almost the same breath. I think they're very different things. I think we should be clear about that, because as a, you know, when we're trying to ask our portfolio companies to measure their greenhouse gas emissions, they'll do that in a wide variety of different ways. I can't really give you a super high degree of confidence about the integrity of that data, because the methodologies could vary, and also it's actually the methodology for greenhouse gas accounting is in its infancy. So what I can say to you is that data may not have a lot of integrity in the sense of accuracy, but I can also assure you there's no greenwashing in there, because nobody's trying to push the results in one direction or the other, and we've got processes to help ensure that. I think that's quite important to say, you know, two different things, particularly not just climate, but you know, as Lucas would say, I expect that impact methodologies are in varying degrees of, you know, development and sophistication.
Just a quick one. What about the suppliers of the companies that you invest in? Sometimes it's a little bit more difficult to tackle the ecosystem and make sure that everything is by the book as well.
Yeah, so that sort of comes out of the realm of impact and into the realm of ESG, and that is, you know, I think at least partly covered by the KPIs that we track. You know, we look at supplier codes of conduct and things like that. It's not a perfect solution. You know, you can never have 100% confidence in everything, but we have a mechanism to do that. But I think it falls more into the ESG risk management category.
Got it. Lucas, before you thanks, Matthew. Lucas, before you answer, I just want to mention the results of the poll. We have about 50% that believe that there is good progress, or even that greenwashing is becoming more rare, or actually compared to a few years ago. So I guess there's a some confidence from our audience about the fact that it can be flagged. Also, my personal comment is that it's also easier to flag greenwashing nowadays with social networks, just by reading comments on social networks and having some kind of a sentiment survey being done over there, in addition to having direct kind of due diligence with these companies as suppliers and the rest. So I guess it's becoming somehow easier. Lucas, anything to add to greenwashing or not, or you just you see that a lot in your daily oncology investment practice?
No, not a lot to add. So I mean, I think I've made some comments earlier around maybe some unintentional greenwashing, just because sort of an underappreciation of the diligence that you can bring to work. But no, I mean, I can't really speak to that as much as Matthew has already covered.
Sounds good. I'd like to add a quick one. Last year, I moderated a panel at Super Return Asia, and invited by our friends here at Super Return Informa. And one of the things that came out in the panel is that some funds, not all of them, but some funds are basically using one marquee deal that sounds like impact to label themselves as impact investors. So I'd like to mention that greenwashing is also happening in the PE industry, because this is also the forum today to talk about private equity investment, and some investors are fairly new but don't hesitate to label themselves as impact investors, and in order to reach out to new LPs or to make the process easier. And a lot of real impact investors, let's say native impact investors, or really committed to ESG and impact, were fairly disgruntled and unhappy about that, because it was kind of blurring the whole picture about impact. So that was one of the takeaway from that panel. Sara, if you're okay, I'd like to move to the returns discussion. And we can get it started with DE&I if you'd like, Sara. So diversity, equity, and inclusion, DE&I. And what do you see, Sara, as far as commitment to DE&I on your clients' returns and financial performance? And that there's a bit of just to finish on this. A bit of controversy, especially recent controversy about Silicon Valley Bank and their D&I commitment, as well as D&I commitment from other banks. And a lot of people are basically, using and weaponizing that tool to say, well, that this is because of D&I that they failed. Obviously, I'm not going to go into the detail of that, but there is a bit of controversy nowadays about D&I. So, Sara, what do you see in that space? And then we'll hear from Lucas and Matthew.
I think that increasing diversity representation alone is not enough. There has to be strong practices that promote equity and equality relating to pay, as well as progression and training. So for example, let's say that you have a diverse senior management, but half of the team can't meet the company requirements to come into the office 3 days a week because of their disability or personal circumstances, like being a single parent. Although the team is diverse, there are members of the team that are disproportionately disadvantaged because of a company policy. So the team function is set up to suit a specific type of person, resulting in those that do not come under that category being able to contribute less than they would otherwise have been able to.
So are you saying that more D&I is going to be beneficial for company performance, or did I understand it wrongly?
I think that we do see a correlation between the two. And I think that it is important, but
Positive.
in and of itself, it is not enough.
Okay. Any of you two, Lucas or Matthew, do you want to talk about DNI? Because I also want to cover returns in general. So, and we only have 15 minutes left. So I want to go, I wouldn't say quickly because it's important, but if you have an opinion, otherwise we'll move to returns in general for impact. Go on. One of it, Lucas or Matthew.
I'm happy to chime in quickly on this. So again, this is, I think if you look at the evidence out there, right, there's pros and cons. There's data to suggest that it actually does not negatively influence or even influences positively the financial returns. And there's data to suggest the opposite. We ourselves have no data in hand today, but we actually are implementing DEI from a broader conviction that we have, from a more fundamental conviction that the diversity actually improves just the group thinking that can be enabled through that, and particularly in a space where we are navigating very challenging risks, we do believe that actually it's a positive, but that's more from a fundamental conviction than actually having the evidence in hand to show that.
In medical field, sometimes you need to have lateral thinking. You need to think outside the box to find new ideas. So I guess diversity in your workforce, whatever, I don't want to use DNI, but diversity is useful.
That's what we believe, yes.
Okay. And Matthew?
Just a quick, not to repeat, but I agree with the point about that it's not about diversity per se, it's actually about the inclusion that you generate as a result of that, because inclusion creates engaged teams. And there's a great piece, I can't remember the author, but there's a great piece of work by the LSE, someone at the LSE about a decade ago, which really suggested that the most engaged teams tend to outperform their competitors over a 10-year period by about 2 percentage points every year to the bottom line. So you compound that over 10 years, that's a significant outperformance relative to your peers in the market. And that's not an outcome of diversity, that's an outcome of the inclusion that diversity and other things can create. That's my view anyway.
Okay, but how do you build inclusion if you don't have diversity? Or
we'll go back to there's many other mechanisms you can create engaged teams, right. But I think diversity is a really important one because it means that people who are not part of the majority feel engaged in the team.
Got it. So we're moving on to our last poll, which is basically the impact criteria, ESG. We've put that together, but it's not the same, obviously. Should they take over or have priority over returns or not? So while our audience is answering this, I'd like to get our hands into our panelists' opinion on measuring the positive or not impact of ESG on your financial performance. I say or not because you always have to think about the negatives. But Matthew, why don't you take it on? Where do you see the positives and where this is going forward?
Yeah, I mean, for us, it's a slightly glib answer, perhaps, but the link between ESG and specifically or rather ESG and impact on long-term financial returns is at the core of our investment thesis, because we're a climate fund, and we wouldn't be doing this if we didn't think that it's going to pay, and it has to pay in the long run to be a firm which is ready for the regulatory changes that are going to come and is ready to help provide the world with solutions to climate change. We are, I wouldn't say we're in a position yet where we feel able to measure that. I'm not sure I would know how to do that, but it's part of really a macro investment thesis for us.
If you were to compare some of the funds from General Atlantic and your specific fund and the performance, it's too early to tell how the performance measures up.
Yeah, far too early to tell. But I would just say, to be clear, we're targeting exactly the same financial returns that you'd expect from any investment.
Exactly the same. Got it. So in that respect, it feeds well into the responses from our poll, which says both needs to be taken into consideration, which also says if both needs to be taken into consideration, my thought is to like you, Matthew, to say, well, the same returns need to be achieved, but with higher goals in terms of ESG and impact, right?
That's always been our approach, that we never intended to sacrifice one for the other. And there are circumstances which I see that might be appropriate, but from our perspective, it was never something on the table.
Sara, do you see, I mean, for your PE clients, do you see an appetite for risk in terms of setting up impact funds? And is there a reluctance or some kind of a worry about the returns, or there is plenty of confidence that this is necessary anyway, and returns are going to be delivered in addition to the ESG performance?
I think there's definitely heterogeneity, but lately the key, I think, overarching comment that we get is that, similar to what Matthew was saying, is that we don't want to sacrifice financial returns. And when you sort of dig deeper into it, I think the key feedback we get is that financial returns really depend on the investment strategy. So impact or ESG, particularly impact, is just an add-on to that.
Okay. Well, I get this is good, because for LPs, it's a way to have both the returns and the ESG component. So ticking two boxes, I would say. Very quickly, Matthew, Lucas, if you what were the challenges for you, especially Matthew? I mean, although your brand name in terms of General Atlantic is well known across the industry, what were the challenges for you to set up your net zero fund? And what would you advise our audience if they have to if they want to venture into that space? They could be GPs themselves or not, or they could be entrepreneurs and they want to set up a management company, a fund. And what would be the challenges, the opportunities, and the challenges for such an initiative? Matthew.
That's a good question. So I would say, based on our experience, I would advise people to decide very early on, assuming you're talking about setting up an impact fund.
Yes.
Decide very early on exactly what your definition of impact is, what it is that you're targeting. I would recommend that that's fairly narrow, because I've seen there are funds in the market, and some of those that we sort of come across every day who are trying to target everything everywhere all at once, and it becomes a sort of a numerical mess, because you're trying to standardize things and compare. The example I use is sort of compare increased educational attainment in India to decarbonization in the United States, and trying to compare those they're just different. They're totally different things. And so I would advise people to focus narrowly and very, very consistently, and not to change your focus at the whim of maybe one LP or at the whim of something going on in the market. Be very careful about changing it.
Right. So have the proper investment thesis that you would do anyway as a GP when you go, I would say, pitch your limited partners, and to have it as a sound investment thesis with proper returns, with the pipeline that goes with it, all these potential companies you want to invest in, and then build it also, the same way you would do for I'd say a plain vanilla kind of fund. This is what you're saying.
I think so, if I understand you correctly. And let me give you an example. So as a climate fund, we're actually a climate change mitigation fund. We're trying to do things that reduce emissions, but we see things, or people talk to us about climate change adaptation, or resilience, investing in things which will help people become more resilient or adapt to what climate change. And actually, it's not completely in that. That's not what we're here to do. We're actually here to reduce greenhouse gas emissions, and it's very easy to deviate, and we do our best to be consistent and focus on what we said we'd do from the start.
Yeah. Okay. So yeah, I was getting into be disciplined in terms of, and this is what you were saying as well, have the discipline to stick to your thesis and deliver the return that you have envisioned for the fund. Lucas, if you were to advise new fund managers as far as going for an impact fund or impact related fund, what type of advice would you give them?
Yeah, I would love to build on Matthew's points around specificity and discipline. I think that really needs to be paired up with expertise as well as solid process, right? So I think we're in a pretty unique situation, and it's almost kind of a natural consequence of the times we live in, that an organization with such wealth of knowledge like the American Cancer Society is embracing impact investing as an opportunity to really enable that expertise to help steward innovation, market-based solutions that can actually achieve the same things as have traditionally potentially been done through philanthropic efforts and activities. And so particularly when you're going after a goal that requires still some nation building, if you will, in terms of what we discussed earlier, your specific framework, setting that up so that, again, then you can actually be focused, having that actually guide your impact management as well, right, over time. I think that is central to be able to set up an impact fund, is actually having that operational consideration of access to expertise and solid processes. So American Society, for example, has been publishing the cancer stats and figures, which is actually the most cited publication in all of science, just because it's sort of a state of the union of where does cancer care stands today. Well, if you have that as a framework, and we use that publication in our impact assessment framework, and we know that that's coming out every year, so it actually enables for that annual updating as well. Those are the kind of things I think that as a foundation, when you perhaps do not have clear metrics such as CO2 emissions, I think is really, really important. So yeah, you can start out with a very bold ambition, but you have to narrow it down. And not only do you need to set specific targets, you need to actually understand how those targets are fed, and also how do you actually maintain the assessment over time. What are you actually tapping into in terms of information streams?
Thanks, Lucas. So we're about to wrap up this discussion, very interesting discussion, and I'd like Sara to have the word of the end. But before that, a quick difficult question for Matthew. You're probably aware that some governors in the U.S., some people in the financial industry in the U.S. are clearly against ESG. How do you see this playing out, Matthew, in the coming few years, or do you think this is going to fade out? Because yeah, go
on. Quick answer, I think there's an awful lot of noise in this. I'm not really sure where the signal is quite yet. My suspicion is it will fade out.
Okay,
I hope
Lucas?
I'm not proven wrong.
Sorry, Lucas, you're in the US. Do you see this kind of anti-ESG rhetoric, or for you this is just noise as well?
Yeah, I think it's noise, and it's sad that it gets so heavily politicized. But I think this is friction on a change, basically a train that's already leaving the station, or has left the station, and it's just sort of inevitable that we're moving here, because there's just too much mobility into that direction. And so I think there's just there's sort of friction on the road of progress here.
Okay, thanks, thank you both for your articulate answer. Sara, the word of the end for you. What would you like to mention for closing this webinar?
I think continuing on the vein of best pieces of advice for people starting an impact invest fund, I think my word of the end would be get a partner of choice to do the heavy lifting. And as we kept saying throughout the conversation, do things with integrity, and feel free to get in touch if you need any help.
And talk about your successes as well, because as you said, a lot of people are under communicating about the fact that they're actually very committed to impact, and they just don't really know how to communicate sometimes. So they have to come forward as well.
Totally. Make sure not to undersell yourself as well.
Sounds good. All right. So thank you very much, Sara, Matthew, and Lucas for making this very, very interesting panel. Thank you, Apex, for organizing it. And although we didn't have time to listen to our audience much, but I hope this was interesting and brought information and help you and guide you into your impact investment process. So thank you, everybody, and talk to you again soon. Cheers.